Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AKA Hotel Residences Corman Communities, Ariel Property Advisors, Amerant Bank, Bank of America Merrill Lynch, Briarwood Organization, Chase Commercial Mortgage Lending, Chase Commercial Term Lending, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, Keysight Capital Partners, Matone Group, New Banks, Newmark Knight Frank, Ocean First Bank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, Stonehenge NYC, SVN CPEX Real Estate Services, Tierra CRG, the Meringer Family Foundation, and these friends. So where could you get a good rate of return on your money? Is it the stock market? Is it a money market? Or is it being an alternative lender in real estate? I don't know, but today I've assembled this group of alternative lenders who provide financing for commercial real estate to be on my show. My guests include Michael May, who's president of Silverstein Capital Partners, Jonathan Chasen, who's the managing director at Moynihan Capital Partners, Michael Hoffenberg, who is the founder and CEO of Trevian Capital, and last but not least, the co-founder and CEO, Eli Tabak, of the Bluestone Group. So you were just saying that you love lending. What do you mean by lending, first of all, and what's the secret sauce in lending today as an alternative lender, as opposed to somebody going to a bank or to an insurance company or so on?
We're in a time in the market where you're seeing a lot of people that had a background in equity, and it's a funny time when it comes to buying on the equity side of deals. So it gives people who have good knowledge about real estate investments to be able to step into a place in the capital stack where they don't have that much exposure and have the ability to earn returns that are
But isn't there a question of risk reward? And I remember in the 90s, in times over there, even with the RTC, that the world has changed. Michael was in a different environment over there. So the world has changed. How do you like being an alternative lender?
It's fantastic. It's much more interesting. I think the ability to generate returns that are dependent on core real estate and financial skills far exceed what you can do in the capital markets, and yet you get the benefit of all the capital markets to help with liquidity and providing capital to the borrowers.
So who's your traditional borrower? Who's coming to you?
So our borrowers are hopefully well-heeled developers that are looking to upsize their projects. So if you've done 15 smaller buildings in Brooklyn and you want to build a 400 or 500 unit tower, those are the types of borrowers that we tend to focus on when they want to upsize their
Michael?
Their deals.
Look, in our space, and we really focus on the middle market, so call it $2 to $50 million. We've lent to everyone from a REIT, a private equity fund, all the way down to a guy who's done a one-off project. It just depends on where they are in the life cycle of the deal and what the deal requires from a capital perspective.
So what kind of deals do you like doing today? The rent-regulated multifamily in New York City has changed ever since June 14th when they enacted the rules. And then we're talking about the condominium world. You know, there's every publication and everything else says there's an oversupply of condominiums around. How do you look at those type of markets? Ellie?
So like we discussed before, I mean, it's all about basis. And we've seen an adjustment in basis when it comes to that. There's a lot of concern and exposure when it comes to these risks, namely the rent-regulated market. We've seen people who are on our side of the business kind of shy away from it, but if they are going to do something, they want to be in a basis where their debt yield going in without assuming any type of upside. And unfortunately, when there's no upside, there is downside. So as long as that's factored into all of that, you know, that gives us the comfort level to step in at a basis that makes sense.
So here's the question. Michael was saying when we were talking in the green room about a large deal that he got involved with Brooklyn, but part of the reason was because of the entity of Silverstein Properties. Let's talk about that deal and the structure of that type of deal for my audience.
Yeah, well, what we like to do is we like to do deals where we have special sauce, is what I call it. And so Silverstein, having built the World Trade Center, having built the Four Seasons, has the capacity, especially in New York City, to build large-scale grand projects north of $1 billion, often with entitlements, tax considerations, involving the MTA on top of subway lines, all the things you see in the deal we did in Brooklyn. So we got involved in over 1,000-foot high construction project on a mixed-use project, a tower in Brooklyn. And all the components that made it complicated, we felt like we had the ability to underwrite either as well as the market, if not better. We had the ability to underwrite the costs, to underwrite the trades, to underwrite the timeline, to look at literally where materials were getting bought on other projects we were doing that same day on that site. And it gave us a good insight into how the construction would go. And then on the condo and also the rental side of it, you know, we've been large-scale developers in the city for a long time. We speak to all the brokers. They're in our offices giving us market updates and pitching us on projects we're doing. So we have a real beat into the New York sales community and rental community. And so we looked at it and we thought we had just absolute fantastic information, and it was a market we liked with great demographics.
Did you have much competition?
We had some. I mean,
because based on the size of the transaction, the magnitude, coupled with, you know, different opinions, I mean, I believe that the condo market in downtown Brooklyn is strong. The rental market has been strong, but there's a lot of new product coming on board. So, you know, when you look, you're trying to mitigate your risks, what the situation is as compared to Gary's deal in downtown Brooklyn that has a 25-year tax abatement, a full tax abatement comparing. So it changes the underwriting a little bit.
Right, but there's an affordable component. There's also a tax component to it. So there's all the things that you would expect. You'd expect in New York City, giving it the tailwinds.
Right. Let's talk about what you've done in the hospitality. Not everyone over here is keen on the hospitality.
So we, you know, the Moynihan Group, as the larger entity, we own over 2,000 hotel rooms, you know, in New York and nationally. So we're comfortable generally with the operations of the business. We've built, you know, we built the largest Hilton Garden Inn in the country, I believe, still over 400 units on 54th Street. So we're comfortable lending to, you know, people developing hotels. The largest deal we've done to date in the hospitality space is the Marks development on 10th and 34th, the Hudson Yards Courtyard Inn, which is directly across the street from Hudson Yards. Also the largest courtyard, I believe, in New York. That deal we were in from the land all the way through the development, and we recapped it and just were paid off 2 months ago, a month and a half ago. So that one went well, and we continue to lend to that sponsor on other hotel projects, you know, throughout the boroughs.
Michael, let's talk about what you've been doing recently.
So we have two different platforms. One's a higher yielding platform, average coupon 7.5% to 9.5% with a couple points, one in, one out. And in that bucket, we're seeing a big trend going back to the conversation we were having earlier, which is this condo construction, completion, and inventory loans. So we like to come in at the end of the movie when we have price discovery, maybe there's a condo or two already in contract. Most of the risk from the construction component is taken off the table. And maybe the project went a little bit too long, costs were a little bit too high, they need some fresh capital to re-up reserves, give them a little bit more term to sell the condos, then ultimately finish construction. So we found a nice niche coming into these condo construction completion deals all over the city, whether it's Harlem, Upper East Side, Nolita, FIDI, et cetera. And going back to your comment, we're more of a bottom-up type of lender. Real estate is very idiosyncratic to the neighborhood that it's in. So we like to look, whether it's in New York City or really nationwide, we're really looking from the bottom up and making sure we're comfortable as a lender at a basis, but more importantly, that the market can absorb those units. Right? Looking at a condo deal in Nolita, for example, what's the inventory of the market? What was the price discovery on the unit that was in contract? And then on the flip side, our other product is a more transitional multifamily focused product, which is L300 to L500. And there we're finding, normal value add multifamily in the 2 to 3 year type of terms with options to extend. Guys that are coming off of a construction loan need to lower their cost of capital, stabilize to a sale, those types of deals.
Ellie, talk about your deals and Flushing, because that's a unique area that not everybody likes to lend.
Yeah. So
because they
first
don't
of all,
understand it.
very similar to what Michael said. We find, not that we coined this niche, but we find ourselves very active in the transitional space of deals. So on the development side, we'll more likely be there, where the borrower is, a well-heeled sponsor, and we'll come in for, bridge to construction type money. And then once they have that construction loan, a lot of times we'll end up putting ourselves in a subordinate position and take a mezz position. The point that Michael May said before about having a lender in there that has the resources and the underwriting capability to be able to take a deal like this down is very important to us if we're going to participate with somebody. In regards to the Flushing market we were discussing earlier, we find that market to be a very attractive market because we find the demographic to be kind of like a captive audience. So, it's the supply and demand in those markets don't flow with the supply and demand of the rest of the city. The only thing is you just need to be careful about who you're lending to and what your execution is going to look like should a default happen, because you really have to be in that market with people.
How do you, as lenders, look at both co-living, which is more of the common Ollie and so on, and the co-working, which is the industrious, WeWork, and the others? Michael?
We've been looking at a lot of co-living, not as much in New York, but in other markets, and I think it's pretty interesting. The co-living that I like the most is when you've got rooms that have their own kitchenettes and have their own ability to lock off.
So they're really a separate apartment,
It's a
micro
studio,
micro studio,
A micro
as
studio.
opposed to the other co-living,
Right.
where it's one bedroom and then you're sharing the other amenities and so on.
Correct. I like that model more, and we've seen, especially in Los Angeles, we've seen a lot of success with that leasing up and getting 150 to 200% more dollars per square foot out of those developments. So I think it's interesting. I think when you're back to more of a student housing, kind of adult student housing, it may work, it may not, but it's tougher to convert if it doesn't work.
Right. We look at the co-living space similar to, what happened with the co-working space, right? Younger people especially want more amenities. They want they want more options. They want more social atmosphere in their apartment units. They want optionality to move around between the properties if they need to be matched with people, all these things. So there will be, an aspect of co-living throughout the multifamily market, in some form or other going forward permanently, we think. Not exactly sure how it's going to sort out. I don't think ultimately people are going to want to live in a student housing type arrangement, as an adult.
It's for a different time period for different people.
When you're a student and you're forced to do that, sure. When you're an adult and you want your own refrigerator and don't want to deal with other people, we think it's going to be more similar to that, where You're going to have smaller units with more amenities.
You know, one of the words today that people get petrified is retail. How do you, as lenders, look at the retail environment? Forever 21 went out of business. Basically, Sears is gone. Macy's is selling some of their properties. So there's a lot of transition retail. How do you look at retail in general? As a lender, will you lend on retail? Michael?
So I want to touch on that, but first just going back to the co-living and co-working, I think what you're going to see in the WeWork and the co-working space is that a lot of folks are going to take the industrious model, which is going to take more of a management contract, and I think those folks were ahead of their time and going away from the traditional lease model, and I think a lot of the new WeWork leases, aside from them buying their own buildings, will transition over to more of a traditional kind of management contract like the hospitality space. But touching on retail, look, retail is going to be here. It's going to be here forever. You know, I think we were talking about high street retail is still very opaque in terms of price discovery. But if you go outside of the New York area or tri-state area, suburban world, the neighborhood shopping center with still your grocery anchored shopping center, you're going to drop off your dry cleaners, go to the bar and have a drink and maybe go get your nails done. For me, I'm not going to the barber shop, but other people do go to the salon. You know, that's always going to be there. Destination retail will persist, and you're seeing a lot of the malls getting completely transformed into different uses.
Rock
so I
climbing.
think there's, rock climbing, their entertainment zones. So I think if you understand what the retail is being repurposed into and you're comfortable with the business plan, there's a place for it in today's world and for the foreseeable future.
Ellie, have you done any
I just
retail?
want to go back on the co-living also. And,
It's a hot topic.
I think very similar to what we see in the condo inventory lending that we discussed earlier. I think there has to be, in our view, there has to be a component of a fallback underwriting of what the deal is going to look like.
And
should the lights
use
go
the
out.
appropriate rental as opposed to the superficial rental.
Now, granted, you'll be a little more aggressive because it is a fallback and there is some type of value for what's been invested in the deal and for the fact that it is a co-living property now, but you're going to have that component. Now, as far as retail is concerned, I think I just echo what everybody else says. Retail is a big...
It's not leaving.
It's big gamut, but, you know, high traffic urban retail is one animal. I don't think we've seen that affected that much. 149th Street in the Bronx, Main Street in Flushing, Nostrand Avenue in Brooklyn, those are different markets. And then we're also seeing a lot of, you know, destination retail where people are bringing in, you know, experiences into retail, and it's just changing the face of retail and demanding the type of tenancy that service that.
You know, something that you brought up and was something that we discussed in the green room was the unsold condominium loans, the units over there. And the two top ideas, one is like a, you know, it's unsold, it remains unsold, or there's the other situation where it becomes a rental. As lenders, how do you look at the unsold in general?
Well, there are a few different kinds of inventory loans that we're seeing. We're seeing the loans that we talked about coming off development, where they just need a little bit more time or wants to get a better rate now that they've de-risked the project. Those are probably the most attractive and the most competitively bid. Then we're seeing loans where the units had been mispriced or slow, but the sponsors are capitalized. They want more time. They want to figure out their strategy. And then we see the ones where the capitalization is just a disaster. The prices of the units is way too high. It's unlikely they're ever going to sell at the price that they're marketed at. And it's literally a kick the can down the road strategy, and you're just waiting for the deal to blow up. And so we're seeing all three of those. Obviously, the last one's the one we shy away from. The most competitive is the other. You know, it all comes down, it's, as everyone keeps saying, it's bottoms up. It's
But you were saying
foot.
when we were in the green room, you know, it's like a tale of two cities in the city of New York. Okay,
Right.
you know, Tribeca is fine, depending on the area, okay? And financial district is terrible.
Right.
Because there's too much inventory coming on and additional inventory coming on each and every day.
New York's such a big city. It's really a micro market city, right? Tribeca, we talked about, there's one unit of 4 bedrooms or more that's new, under 15 years available, and there's only 40-something units of new supply in prime Tribeca coming on, period, the cobblestone streets. You literally go on the other side of the World Trade Center, you have the financial district, you've got, at the prices they're selling at, 10 years of inventory. And they're a mile apart. So it's really what block you're on, what neighborhood you're on. The demographics are completely different. The buyers are completely different. It's a real micro market city.
I think building on what Michael was saying, I think there's three things that we really look at. Is one, does the building work as a rental? You know, if not, okay, are you comfortable in it as a price per square foot? But what does that equal on a whole dollar basis, right? So if your price per square foot's a little bit higher, but the whole dollar is a bite size that the market can consume, then maybe the deal works. It's a 5,000 square foot apartment or a 10,000 square foot apartment, and the whole dollar chunk is massive. That's a completely different analysis. So we're hyper focused on those kind of three little.
We only lend on condos if you can underwrite it as a rental. We are not great condo lenders because of these issues. Huge bite sizes, opaque basis per foot, and then the sponsorship. Often what we're seeing now is a little bit of cash out at the end, or pay up the reserves, give me time. I'm not willing to, adjust my prices yet, but we'll see whenever that happens.
And to Michael's point, I mean, ironically, when we see a lot of these, and maybe you'll agree with me, when we see a lot of these inventory loans, once you start peeling the onion away, you realize that 30-40% of the units are those big bite-sized units.
Right.
And
Yes.
that's where your value is coming from on a price per pound, but you're not moving a $12 million unit out the door in this market.
So what do you do with a $12 million unit?
The simple thing is 10% of your units
Have to be
going to
sold.
20,
Right.
going to 30, have to drop in price 5-10% every month until you catch up.
When Ellie arrived early today, so he was saying that there's a lot of distressed debt becoming available. What do you mean by that?
I think a lot of the distress that I'm seeing that's becoming available is around these condo inventory loans that weren't originated now, that were originated 8 months ago, and there's no risk in the deal. All the skin that the sponsor had in the game was
They took out
exited
all their money already.
with that. There's nothing burning under them to get these units out. Now they're dealing with a maturity. They're dealing with an inflated condo values, and maybe LIBOR was somewhere else when they started the deal, and all these things come together, and a discount in values of 20%. And
What about banks today? Are they becoming more conservative today than before?
Having started an alternative lending business in 2010, I mean, no one was lending in 2010, right?
Right.
So it's hard to find kind of a more conservative, worse environment, unless maybe you went to 2009, right? But 2019, I mean, people were more aggressive. But I think one of the things I continue to believe is underwriting standards have not dramatically shifted. People have taken different views on risk. The markets have moved. But there hasn't been, even with alternative lenders, I haven't seen a wholesale shift to pro formaing rents and thinking things are going to grow quickly. I think people are still pretty conservative.
Right. And I agree. I think that specific year, 2010, was sort of the rebirth of the CMBS industry, and when banks actually started to be able to lend anything again. So that was a specific time. 11, 12, you started to see banks have some balance sheet, but banks have been conservative for 10 years already. So that is why we all exist in our form now.
Let's talk about sources of capital. We were talking that both of you have tapped the Israeli bond market as a means for you to lend. Talk about that.
Joe actually did his initial offering way back in 14 or 15, I think, before I joined the company. We did another raise a year ago in Israel, $200 million at 3%. The market is different now in terms of, there have been a certain number of
Defaults.
issues that have come up,
Right.
obviously.
Nothing of the people on my panel today, but there have been substantial defaults in the multifamily and certain of the construction.
Of course. And so, like with any new market, that's a learning experience that investors have to understand. So I think there's significantly less liquidity now than there was, even 2 years ago or a year and a half ago. I think we're all figuring out how best to navigate it. It's still extremely competitive product, but it's not as liquid or as large of a market as it used to be.
Michael?
I think Silverstein's having a great experience with it. I think we're the only AA rated entity on the exchange, and maybe that somebody's been added. So we're considered, I think, one of the best, if not the best out there. And so we've gone back and tapped the market 2 more times. The difference, I think, in terms of us versus your strategy is debt's one part of the overall collateral that we pledged for the bonds in Israel, and it's a small part. It's not the majority
It's
of
not
it.
the
So
majority.
it's primarily real estate owned assets, and so debt's just a small part of it.
Michael, you were
the bigger
bringing
picture.
Just to be clear, our portfolio is backed by equity interest in properties that
and
we
some
own.
debt also.
All of the lending that we do with that collateral, with those funds, is collateral for the Israeli entity.
Michael, you get some money from insurance companies. How do you see insurance companies today looking at the environment?
Look, I think you're seeing, in specific to maybe the multifamily market, with Fannie and Freddie pulling back the way that they have, a number of other lenders, more conventional lenders, are filling the gap. So a number of your traditional life company sleepy lenders are having their day right now and picking up and filling up their balance sheets with a number of really good loans, specifically in the multifamily space. And I think that echoes, the same is true with CMBS and going back to your comment regarding banks, whether it's local, regional, or national banks. So I think Fannie and Freddie pulling back has really helped that market. And the same goes with office and industrial, right? It's a competitive landscape right now, and there's not a shortage of capital, whether it's from all the alternative lenders today that are on the panel or the 5 more that'll start up tomorrow. Everyone loves the debt space because the equity space, it's very difficult to make the numbers work.
What about the suburban office market?
We don't look at too much suburban anything, but in my experience, it has to be full, and it has to be long-term
Cash
leases.
flow on lease.
We drive through it on the way to and from the markets that we lend in.
Exactly.
So, I mean, in conclusion, the apple seems still bright and shiny over here for the period of time, and I think alternative lenders have become a larger segment of our market over the last decade, and I think it's going to continue. And I think people, when they realize there are different opportunities, they will tap all of you when they're looking for a loan, and certain are applicable to you, and certain ones aren't. But I'd like to thank Michael, Jonathan, Michael, and Ellie, and see you next week.